You're sitting there looking at your napkin math and realizing how amazing this apartment building is, and it's probably too good to be true. Well, we're going to talk about some stuff that you should be considering in your due diligence today before you put all these terms and conditions in your APS. So stay tuned.
Hey guys, Josh and Ehren back with our Finance Friday, and in today's video we are going to touch on something that we always say you should do but haven't really dug into it probably since we first got into the shooting videos. We're going to talk about proper due diligence on a pre-existing multifamily building. And we have a lot of clients who are looking to acquire these buildings. It was really hot a few years ago. There's opportunities coming up right now. And we get these deals from either appraisers or realtors or people who are selling, people who are buying, and it seems to be a wide range of ability to be able to look at a viable purchase. So today we're going to break down what you should look at and if you're missing anything. So let's dive right into it.
Yeah, obviously when you are assessing an asset, you want to make sure you're assessing it appropriately. I'm sure there's been a lot of times where maybe you get given a homemade Excel sheet and there's a few different numbers on there, and there's a 0% the vacancy because nothing's vacant and they've been personally managing it, so there's no property management costs, and you run your numbers and you have a gold mine. But realistically, those aren't the expenses that really go into the actual underwriting of this building when it comes down to the lender. So obviously, item number one here is making sure you have the legitimate and most accurate income and expenses for the property. Ideally, if you can get it, a 2 to 3 year financial statement for the building. This can either be, if it's held in a corporation, it's the sole property. Maybe you just get, a financial statement for the corporation for the last 2 to 3 years, or some sort of like internalized profit and loss statement, but something that's going to show the actual performance of this building. Something that's going to actually detail the expenses, for the building that have been recorded for the building. If you can't get something like that, or if you can, in addition to that, getting the most recent final property tax statement. If you're looking at doing some sort of acquisition and you're going directly into CMHC, you're going to need at least 12 months of utility statements. So trying to get some proof of expenses there for the utility statements. If you're getting your own insurance on the building, you're going to be able to get your quote there. The rest of it we can kind of fill in with the lender template. But those fixed expenses that you're going to have, again, let's try to get some concrete proof on these things so that we can actually verify the data, and we're not going to get an absolute shock come credit review time when we've just been running numbers on an Excel sheet.
Absolutely, and I think if you can get the financial statements, obviously seeing multiple years of history of verifying all the income and expenses and then average through the years is ultra helpful. And when you have a rent roll that maybe another investor has purchased or has given to you and they've only had for a year or so, how one person operates a building for 1 year isn't necessarily reflective of the whole operations of a building over time. Just keeping in mind that you also might not be able just to get financial statements from the seller. Like they might not feel as though they should provide that to you, or they have multiple assets in their financial statements and they don't necessarily want to share it. But diving deep into the actual documents themselves, your leases, make sure you get every single lease. Make sure that you verify every single lease, what is included in regards to what you're responsible for paying in regards to utilities and what they're responsible for paying. Sometimes legacy leases will have the landlord assuming or paying for some of the utilities that other tenants aren't paying for. So keeping track of what you're responsible for and what they're responsible for is really important. And when you're buying a property at the end of the year versus the start of the year, and when your actual property is going to close is also important, because N1s are issued usually at the start of the year by the previous landlord. So if you, let's say, acquire property in November, but you don't close until February or March, it's possible that they have an N1s already in place, and those N1s are going to give you a higher net operating income than what you actually bought the property for. So, verifying the N1s, verifying the actual leases, go through them line by line, take your time. So you usually see people kind of skip over that and just take a look at what the sellers provided.
Yeah, and I mean, there's other benefits with having a record of multiple years, right? If you're taking a look at repairs and maintenance and you have one big year, maybe they replaced the roof and the boiler system and a bunch of windows, like they did everything in 1 year. Well, that's a one-off, right? That's not going to be your average repairs and maintenance on a building. So if we just get 1 year of operating statements and it's $100,000 to, repair and manage the building, when normally maybe it's only like $20,000 or $30,000, that's something that we can go back to the lender and say, hey, look, here's the historical data. It's not actually $100,000 like the appraisal used. This it's actually this. They did a bunch of repairs. So we can take that and go back and we can help to soften those numbers. From a CMHC perspective. CMHC uses their own vacancy data as well too. Some areas down to the neighborhood and into the zoning, your numbers can be quite a lot higher than what you're expecting in a generalized area. I've seen some stuff in Alberta, in Edmonton, where Edmonton on a whole maybe like 3-4%, but in one random neighborhood, CMHC has vacancy data of like 12%. Well, if we have historical operating statements and rent rolls, and we can prove over the last 2-3 years that this building has had zero turnover and it's been fully tenanted for the last 3 years, well then we can use that to argue and bring down that vacancy rate with CMHC and with the lenders, which is in return going to help with your NOI and your overall affordability of the building. So just having these documents to back things up allows us to have some firepower to be able to help fight on your behalf with the lender to bring your expenses down and increase your affordability.
Yeah, who you buy from is also really important. If you're looking at mid-sized multifamily assets that have been managed by a fund or managed by a large group that has to spend the capital on high levels of maintenance on a building, a lot of these funds will over-maintain buildings. They will make sure that they have a cleaner that's in there twice a week. They'll make sure that absolutely everything preventatively is also done to the building. So they might have a higher cost of maintenance on their actuals than you would normally use when you're looking at benchmarks. So when you're looking at the real expenses versus the benchmark expenses, you have to kind of make sense of what kind of person are you buying from, because CMHC's benchmark maintenance expenses might not be reflective of the current expenses, but are they reflective of the actual expenses that a normal person would take? Another thing to keep into consideration too is if you're buying from a mom and pop and you're buying from somebody who owns a building and who has owned a building for a period of time, or somebody who has like a large portfolio, a lot of the times when you have a property and a corporation, there are advantages of owning properties and corporations. Sometimes you'll see additional expenses that make their way onto the financial statement that aren't necessarily tied to the building operations itself. And you should take that with a grain of salt, because a lot of the times maybe a kitchen renovation at somebody's house made it onto the balance sheet of a corporation that is selling a property to you. A lot of the times they won't share with you the actual line by line cost expenses that are broken down. So sometimes it is best to take a look at just the benchmark expenses that we use to underwrite deals. A lot of the times it's reflective of current operations of a building, but if you do see outliers, it's important to highlight those outliers and ask the seller what that is.
Yeah, absolutely. Continuing with that, reports in general. Obviously an appraisal going to be important. Environmental, potentially, depending on the type of deal you're doing as well too. With appraisals, every once in a while I see a deal where the seller has an appraisal that's being provided. If you can help it, I would definitely not take that appraisal, right? You don't know what kind of information was passed along or given to that appraisal. It's most likely going to be in favor of the seller, right? It's just typically going to be a buyer's report. So if they're giving you one, great, take it with a grain of salt, review it. Maybe it'll give you some insight into some of the details, but again, always get your own appraisal. Make sure you're in control of the details that you're actually sending to the appraiser, right? And ideally we're giving them these statement backed documents just to be able to make sure that they're underwriting it appropriately. So just again, don't just accept appraisals from the sellers. Environmentals on every CMHC deal, except for 5 or 6 units, you are going to need an environmental report. Ideally, it is going to need to be done within the last 12 months. So again, if there is a pre-existing environmental, we can try to use it. If it's clean, saves you a little bit of money, good to go. Depending on the age of it, we may need to get a new one. Doesn't necessarily need to be done for the date of submission into CMHC, but definitely needs to be done come time for financing. Another report that you can get, which I think in general general is a good report to get, but not always required, is your building condition assessment report, or your baseline property condition, your BPCA. It's really going to dive into like the deferred maintenance and the potential ongoing costs of the building. It's going to be done by a structural engineer. They're going to come in, they're going to do a deep dive into the overall building. It's going to tell you your immediate costs of repairs to be done to the building, but then it's going to take a look at your next 5, 10, 15 years as well too. So if you're putting all this money into a large asset, especially with the emergence of MLI Select and the ability to get buildings done at a 1.1 debt service ratio, well, if you have $100,000 in deferred maintenance that's going to be coming in the next 10 years, and you're qualifying at a building at just a 1.1 debt ratio, do you have the cash flow in this building to even be able to support the upcoming expenses and repairs and maintenance on that building? Or do you need to make sure that you have, a pool of liquid capital to be able to draw from? So again, most people don't typically take this report if they don't need to, but I think it's a good report to have just to be able to give you an idea of how the building is going to perform from like a structural integrity.
Yeah, absolutely. I think great point. A lot of people are looking at higher leverage options on these pre-existing buildings, but these, from experience and purchasing these types of assets, these 70s like low-rise apartment buildings, nothing is being fixed, or if they have, it's being barely fixed. Like major repairs. You got a brand new roof. You have all new asphalt, interiors, exteriors. You have the heating systems, like you possibly have to take out like certain systems within the building itself, like major costs. So even if you're making like $30,000 or $40,000 a year in net cash flow on a building, like if that might just go to cover the actual maintenance cost of the actual building itself. So we always try to advise our clients to take them if you're buying a pre-existing building.
You could even from to protect the JV partners out there, if you're JVing on a building, you may even want to just recommend that your GPs get something like this, because if part of your deal agreement is you get the cash flow out of the building for the next 5 years, and year 5 you have to do a built-up roof replacement or an entire HVAC boiler system, like that cash flow may not be there, or you may get it and then just be required to put the capital rate back in. So from an investor partner, maybe something you want to get done.
Yeah, absolutely. And I think another thing to take a look at is underwritten cap rate versus appraised cap rate. So really dive into your reports that you have, or have the professional that you're working with dive into that report, because what is happening is if we're underwriting and CMHC is underwriting your file, and they have additional expenses that your appraisal doesn't have, their underwritten value will lower the cap rate. And if your cap rate on your appraisal is higher than that, they may move their cap rate to the appraisal and lower the internalized value, which will increase your total down payment and lower your leverage on your property. So when it comes to understanding CMHC benchmarking expenses and what your actual debt that you're looking to place and how they are assessing your net operating income versus the appraisal that you're going to have, it's important to understand that both your appraiser and us, your financing partners, are aligned with the expenses that are supposed to be reflected on your appraisal. Not everybody has a chance to be able to understand the internalized benchmarks. CMHC doesn't share those things. They don't share the fact that they change how they look at either a concrete frame or a wood frame building, and below 11 or above 12 unit classifications. So, all things to keep in mind as to the reason why when we're looking at a file as well, we're going to determine if the underwriting is aligned with your appraisal.
Yeah, and even just on the cap rate, like again, going back to just having like an Excel sheet provided, if it doesn't have management, it doesn't have any vacancy on there, like that NOI is just naturally going to be higher, and from a seller standpoint is going to reflect, hey, you should be buying my building at a 2 cap because the value is there. But when you add in vacancy, property management, and some of these other things that the lenders look at, that NOI drops pretty quickly, and that cap rate starts to drop further because again, you have to have a lower cap rate with lower NOI to be able to reach that purchase price. So you may seem like you're buying it at a 2.5, but you add in vacancy, property management, and some sort of like maintenance repairs or something, and now all of a sudden you're buying it at a 2 cap or 1.5 cap. Like Josh said, that's where the lenders are going to have issues with that value, and you are probably going to have to be injecting some equity.
Last but not least, let's get into pro formas. Probably the funniest parts of our day is when we get to see what realtors are projecting out for rents and operations of a building. So after you buy the building, the whole point is to increase the efficiency of that building, and you want to be pretty conservative with how you're actually looking at this. So realistically, what you should do first is understand, how is my building operating as is? So you know what the income is, you verified all the expenses, you've added in your vacancy management, maintenance, and you really know the net operating income of this building. Next thing you want to do is you want to look at, well, how is my building going to operate at maximum market rent? Let's say the stars aligned and I have been able to have market rent in my building. What does that look like? You want to take a look at your rents. So, talk to your appraiser, have an appraiser go and give you possibly an as complete valuation, doing a market rent analysis, understanding how much rent you can realistically achieve for, the unit suites that you have in your building. And then you're going to want to understand what is success when it comes to actually executing on this. Realistically, 100% turnover in a building, that's not success. You don't want to do that. So have a realistic understanding of what you can actually do to increase those efficiencies. A lot of the times when you're looking at expenses such as insurance, when you're looking at old insurance bills, a lot of these legacy assets were purchased and owned possibly 20 years ago, and a lot of these guys haven't necessarily went and got new insurance. They've kept renewing their insurance with small escalations in that insurance. So oftentimes you're seeing, 30, 40, 50, maybe even 60% increases in the stated insurance versus the insurance that you're going to be getting on the open market today. I was taking a look at a deal today, and the difference of insurance was like $4,500. And at like a 5.5 cap, that's almost $100,000 in value for a $4,500 difference in insurance. So when you're looking at your pro forma, you want to understand that your projected operations of this building is going to have higher insurance costs than you normally would with the stuff you have now.
Even just looking at the utilities and, again, like government policies, right? Like, are they cutting carbon taxes? Is carbon tax going to stay? Is it increasing? What's going to happen there, right? Like, again, like Josh was saying, buildings that have been legacy owned and owned for a while, those taxes, those costs may not be passed along yet to the actual bills and reflective of that. So again, if you're buying something, keeping in mind policy changes and stuff like that, they're going to be coming down the road, that is also going to impact any of your underwriting on your buildings as well. Even just adding inflationary expenses to or inflationary costs to your expenses across the board when you're doing your underwriting, especially if you're getting into a bridge loan and you're not buying a stabilized asset. You're trying to predict where your financing is going to be 12, 18, 24 months down the road. Add that 3% in there: property taxes, insurance, your utility costs. Really, you're just trying to safeguard against any sort of increases down the road. If you underwrite with your inflationary costs added into your expenses, well, then that you don't have to necessarily worry about that down the road. We know a lot of regions haven't done municipal tax assessments, and I think a lot of them are coming up in 2025, I believe. So could be quite a few increases in property tax across the board. Again, just making sure that you have those details in there, safeguarding as much as you can. Obviously, there's not really much you can do to be 100% accurate with it, but adding that buffer in there is just all it's going to do is protect you down the road.
Yeah, absolutely. I think that's one thing that a lot of people don't take into consideration. They'll just take the as-is expense, and they won't factor in the fact that everything gets expensive annually. So when you're trying to project out your net income annually and you're trying to project out multiple years, you should really be adding to your expenses as well as your net operating income as you increase your rents by 2.5%. That being said, last but not least, we should talk about interest rates and what you should be looking at when you're projecting out your pro forma. Don't underwrite your file at 3.75% if you have like a $2.5 million file. Don't be ultra aggressive on your takeout financing projections in this market. We are having massive volatility with the CMB right now, and we saw a 40 basis point swing in the last 2 weeks. Being conservative is your best friend in this case, and a smart investor told me one time, if you have to try to make the numbers work for a deal, it's probably not a good deal. Be true to your actual underwriting, be conservative. Add another 25 basis points to your takeout financing on your max rate if you are underwriting it yourself. We do it internally. We take the conservative approach to your underwriting, but don't be over aggressive when it comes to projecting out your interest rates. We do anticipate, based off the current yields, the Canadian mortgage bond continuing its trend, barring any sort of black swan event, that bonds will continue to trend down within at least the foreseeable future, based off of the economists that we follow. Now, that being said, in 12 to 18 to 24 months from now, that might not be the case anymore. So be more conservative when it comes to underwriting your files.
Yeah, if your project only works on projected rates going downwards, may not be the strongest project to get into, because again, if those rates do shift quicker than what we expected, that project is no longer viable. So, don't bank on that being the key successor to your file.
Well, I think it kind of leads to the next conversation, which is just like equity position in your project. When you're buying a multifamily project in today's environment, I'm going to echo something that Ehren and I have been stressing for a while, is you can't do this without capital. And having a buffer in your ability to be able to keep capital in your project is going to be important. Things are going to cost more. Timeline is going to take a little bit longer than expected, and in a case when you do have projects that are going a little bit over, or you have a Canadian mortgage bonds a little bit higher, or you have the policy rate decisions that continue to increase, it's important to have liquidity to be able to make sure your project is successful. And contrary to what happened maybe before 2 or 3 years ago, investing meant keeping money in a deal. So that might actually be something that's consistent moving forward, which we believe that you should be well capitalized to be able to take on a project like this. Guys, if you guys enjoyed this video, if you like this video, please hit the subscribe button, hit the like button. Ehren and I love shooting this for you guys, and we are looking forward to shooting the next one and seeing you guys next week.